Going live. And we are live, AUS Property Investors Wednesday nights. Bringing the big names, and Sam is a big name, and we're going to have it is a big and a long name. We're going to have some big fun in the group. So, how you going, Sam?
I'm good, mate. How are you guys going?
Well, I'm pumped. Jeff is frozen.
I want to hear how Joe's going. Oh,
mate, your internet's a bit screwy there, Jeff.
Your internet's rubbish.
Okay. Mate, jump on your bloody hotspot or whatever. But no, mate, I'm good. My day's been good. My week's been good. That's upsetting.
Yeah.
But okay, Jeff, how are you, mate? How are you, Jeff?
My day was really good. Like I had this last 2 hours of the workday, which was just super productive. I was like, what the heck was I doing? What am I doing this? I pretty much just got so it was a really good day, and then the time just got away. So I was just so excited looking for this conversation. So let's crack on to the life hacks, because I want to get so much. I want to soak in the wisdom of SJN. I want to surf the capital growth wave of SJN. So what's your life hack for this time, Dan?
My life hack is maintaining basically what has always worked and the fundamentals that have always worked, because I think especially at the moment with FOMO and a nationwide boom, a lot of people just jump on certain things and trends that are just for here and now. But there's fundamentals that will always be there and have always been there, and my life hack is to stick to them because that's what works.
Yeah. I'm all about that.
Interesting.
Yeah,
I think we're going to dig into something like something about molding your strategy. So it'll be interesting to hear, to unpack that a little more. But Joe, what's your life hack today, or do you want me to go first?
No. Well, I guess my life hack was actually very, very similar. There's a fantastic book that I love called Principles by Ray Dalio, and he just has principles for life and principles for work. And that's kind of my life hack is start thinking about like your life and your work and your investing like principles, and just have strict structured, pretty much like what Sam was talking about, but just have rules for your life that make things a lot easier. So one of my rules for life, not for work or anything, is don't drink coffee after 3 p.m. So now when I get offered coffee at 3:30, I'm like, oh, I want to. No, that's my rule. I won't do it. Now I can focus on the future things.
What about 301 though? What happens to, or maybe it's a tick
called rules.
Maybe it's a 258
for a reason.
Like,
258. We're all good.
My mindset is rules are made to sometimes be broken. But anyway, that's interesting.
What's yours,
Joe?
mate?
I was listening to the podcast and that. So mine very briefly is absolutely life changing, because it was painful managing the rents coming in for all the properties. So if you're a property manager and not running this system, I would implore that you have to do it. And if you're with a property manager not running this system, so it's called Property Me. So I'm not sure if you've heard of it, Joe or Sam, but Property Me, it's so UX is probably could be improved a little bit, but it shows you exactly. It's like a general ledger, and I don't know if you're on it, but it's amazing. I'm like, what the heck have I been doing all my investing career until I got onto this? So that's my life hack. Get onto Property.
I hate Property Me so much.
Yeah. You hate it. You don't like it. Why not, Joe? I love
Have you got it, Sam?
It's really good.
I've heard of it. I don't have it, but no.
Yeah. No, it's just the UX is terrible, and the property managers get really like, oh, it's in Property Me. Why didn't you look at it? I'm like, it's been in there the whole time. Why didn't you tell me? Oh, because it's in the thing and blah, blah, blah. Anyway, it's probably me for being lazy.
I think it is, Joe, because I found before that I'd have to look through a whole heck of emails, whereas now it's all in one place. I know where it is, and I get notifications, and maybe my property manager is really good. So before we get into our first, I want to, if comments, questions, thoughts, ideas, throw the likes. We love hearing, because the more comments we get, the more excited Sam and our guests get, and the more excited Joe, and so all that good stuff. So let's crack into the value, but first we've got some more value to bring you from one of our sponsors.
God, that sounded like a paid ad, didn't it?
Yeah, I thought it was smooth. There's no sounds, Joe.
What's going on, everybody?
Have
a feeling there were some technical issues on that one.
That didn't work at all.
Every week Joe has and you were flogging me as well.
There you go. It is live.
I think we owe Scotty at least another 1 or 2 weeks.
Yes.
Yeah, I think we are.
So moving forward, though,
SJN.
Well, maybe yeah. I don't know. Eventually, when we. I wanted to get you back for another time. So you've recently bought your 5th property. You are the capital growth mogul. I suppose I think you bought your first just after being 18. Sorry, start of sort of not turning 19. So you've sort of been investing for at least sort of almost one cycle. So you've been kicking goals, and I would say you've got a lot of equity now, and I suppose you've got a lot of experience. You've spoken to a lot of people and done a lot of things. So that's my intro for you. Sort of fairly ad lib. So where I think we should start off with is take us back, because we didn't ask this question last time. Sort of asked in a roundabout way, but I'd love to tell us about your first property. Like what was the experience? Where did you when did you buy it, and what rough area? How did it all go?
So basically, when I first looked at buying, I was kind of lucky in the sense that I did read a few property books and that kind of thing first. So and I did know people in the area and sort of some idea of what was going on. So I'd always been interested in real estate ever since I was quite young. I read, as you know from the last podcast, Robert Kiyosaki's book, Rich Dad, Poor Dad, when I was honestly about 15 or 16. I was quite young. And then I've also read plenty of Michael Yardney's books and other guys called Conrad Boblak's books as well. So I had kind of an idea of basically what capital growth was, what the compounding effect of property was, and how leverage kind of helped you in creating that equity fund, and how cash flow worked as well. So the idea where it came from for me was basically sort of following people who had success in the past and then molding a strategy around what would happen you could kind of justify to happen in the future. So I knew, for example, that a critical shortage of stock was one of the key contributing factors to capital growth. So basically where I first went looking was look where there's a critical shortage of stock, coupled by a high income demographic. So that's basically how I first started looking for property. So
before you made that decision to choose capital growth, there are a lot of books out there that talk about cash flow positive, or off the plan and tax depreciation. Why didn't you go down I don't know, maybe not the tax depreciation. We've already cleared off why you don't go down that route, in other episodes and stuff. But why didn't you go down the cash flow route? Like, that makes sense, right? Your goal is to retire. Why wouldn't you want a passive income constantly coming in initially?
Simply because cash flow. So I do agree that you do need to be honest, to build a portfolio. I understand now that you do definitely need both, but we'll get onto that later. But anyway, mainly the reason of capital growth is because if you look at capital growth over a point in time, what happens is because the value of an asset is going up so much, it eventually will turn to cash flow positive, because the yield will go down, but the rent will slowly creep up, because if hypothetically you've bought a property for $1 million, right, and it's going at, let's say, 8% capital growth, it'll double in probably 9 years or so. So the rent's not going to stay at
12.7 if you rule of 72. Yeah, sorry.
Yeah.
Sorry, go on.
Yeah, no, you're right. But anyway, with that principle, the yield probably will go down. So hypothetically, if you think about a Sydney house, for example, say 8 or 9 years ago, you probably could have got quite a good asset for $1 million in Sydney. You would have been able to buy probably in some places the lower eastern suburbs for that, some places maybe in the even upper North Shore for that as well. And you would have probably got about a $500 rental return at that point in time. So a fair return at that point in time. Now, if you look at what they are now, the rental return's probably only 1.8% as in a yield, but you got to remember that's 1.8% of $2 million. So it's actually cash flow positive on that original loan. And that's what people don't realize. When the value of something goes up so high, the yield of the asset does go down, but you've got to remember you've purchased it at a point in time where you've purchased for half the price it is now. So you've got definitely a couple of $100 coming in your pocket there. And you've also got this equity, which you can pull out and buy further assets, which is fundamentally what you want to do in property.
Yeah, absolutely. I mean, the gross rental yield, which is what you're talking about there, is what allows you to compare apples to apples. But if you're not looking at the net cash flow, it's not going to work. You're not going to know and be able to compare if you don't include your leverage in there as well. No. But how did you actually? Because what I was trying to say back then was, like, when you're first starting out, cash flow looks so spectacular. That was the route that I went down. I thought, hey, I don't need capital growth. I need cash flow because that's what I want to retire on. But what was some of the key books or the key resources that allowed you to be like, actually, no, capital growth is the area that I want to focus on in the initial stage?
I went into a real depth kind of analysis as to how the guys that I kind of followed got their wealth and basically the effect of compounding. So I did a really in-depth research of certain areas in Sydney and Melbourne that had done very well. And I could literally find places, for example, in a suburb called Kew. So that's in a very inner suburb of Melbourne, a very affluent suburb now, where you could have bought back in 1890 blocks of land literally for £50. So if you index that is literally 8.5% capital growth for 130 years. So because they're going for about $2.5 million now, and you can even see places, for example, in the northern beaches like Balgowlah in the northern beaches, close to where I am now in Manly. But anyway, that you could have found 40 years ago for $22,000, $21,000, and that kind of thing. So yes, you can buy cash flow properties, but if they're only doing 2 and 3% a year, an average or something like that, are you even beating inflation? Because your real return, you've got to consider inflation, and in a high inflationary period, which we probably are in now and will continue to be for a while, because stimulus, are you even actually making any money? That's what you kind of got to ask yourself.
I think we should definitely touch in on that.
Because controversial on the inflation, because you've got CPI inflation versus asset price, asset inflation. Which then you've got because CPI is a bit of a furphy, but I mean, I don't know. So the last time we were on, we spoke. So when we talk about sort of metrics you were looking at there, when you're on, we spoke about income levels, debt levels, previous resale value. What are the sort of what are the free things though? I mentioned free things there, but are they outside those things? What are the free things you look at when you're when you're looking at when you're wanting to get capital growth or wanting to see capital growth?
So an interesting one actually that not many people, I would say, really do much research and can actually find is, I find development restrictions actually a very, very good competing factor for capital growth. So the reason for that is because if you've got obviously a set number of stock in a suburb and let's say a set number of demand, right? If there's harsh development restrictions on there physically cannot be any more stock created. So if you can't go up and build units, you can't subdivide or anything like that, then you've got a critical shortage of stock and you've got the same amount of demand. So there's certain areas in Sydney as well, and in Melbourne as well. There's plenty, I'm sure you can name around the country, if you know your councils well, that have these development restrictions, and that creates even a further shortage on stock. So that
what's a development restriction?
So it's, for example, covenants that don't allow like building heights, doesn't allow subdivision and that kind of thing. So this is an area where most people would buy in Sydney, for example, but there's a certain area in Strathfield Council that is completely, it's called the Golden Mile, and the council's pretty much completely against any development there. So what you have is an extremely high income demographic living there, but you have basically no more houses or dwellings being built. So what happens then is people don't want to sell their place there, so that puts more pressure on stock. And then second of all, more people want to move into there, but there's no more stock available. So straight away, the supply and demand equation becomes stronger and stronger and stronger, and that obviously puts upward pressure on prices. And second to that, because people aren't selling their houses, a lot of people have so much locked up equity in those houses that they're never going to sell them anyway, because they probably can't even afford to buy back into them in the first place.
Yeah. I guess I'm thinking about what we spoke about last time, and last time we spoke, we had about 1,000 people in here. So guys, let's just talk like we're normally talking and not worry about if we repeat stuff over and over, because we've got 7,000 more people. So let's not, because I feel like we're avoiding some of the more basic stuff that we covered that's foundational to the core. So one of the things I wanted to ask is on that development side of things, like how can, as a beginner, how can I start to identify these things? What creates the golden mile? Like easements, like what else? How does it actually get made, and how can we find those opportunities outside of Strathfield and other places?
Yeah, well, basically most councils, they'll have a land and environment plan or something to do with that, or development control plan. Most of them do outline basically what restrictions they have. You'll see certain councils are a lot more development pro than others. Not that I think that's the only factor that affects capital growth. It is one of the factors that I do personally think can affect capital growth, because it obviously plays a big part in the supply and demand equation. But basically, that's where I'd go first of all, looking for those sorts of things. You can also see a lot of councils as well. You can see they'll have, for example, precinct plans, which is development plans for sort of whether that's medium density, high density, or anything like that. That will also affect dwelling prices. In saying that, people on larger blocks in those areas, in precinct areas, will do very well in regards to capital growth, because the land value will shoot up a lot, because you can obviously subdivide and do other things with the land. So that's another thing I guess you do have to consider if you're buying for capital growth, should I say. But that's one of the ways I'd say you can definitely find that sort of information out.
So keeping in mind what Joe just said about given that we've got 6,000 or 7,000, how many other people more?
Yeah.
Let's look at the other factors that I didn't mention that I glossed over.
Yeah.
What are those metrics that you look at if you're keen to focus on capital growth?
Yeah. So me personally, there's two main areas where capital growth usually occurs, and it has consistently occurred for decades and decades and decades. So the main two areas I look at has to be within a close proximity to an affluent city. So an affluent city, mainly meaning Sydney and Melbourne in that sense, because they are significantly more affluent than every other city in the country. And the fundamental reason of that is because if you look at the ASX top 50, 39, so that's 78% of the top 50 companies are stationed in either Sydney or Melbourne. There's some in Perth, but that is only driven if there's a materials or mining boom fundamentally. That's the reason. And the second thing is close to the water. So properties that are in close proximity to the water often have a high income demographic living near them. And that's pretty much shown historically throughout. You can go literally back to like 1950 and 1940 and find statistics regarding that. But anyway, that's two of the main things. And the other thing with being close to the water is there's kind of an extra part to that as well. Being close to the water, there's often what you have is a large variance in properties. So for people that have followed real estate recently, you can see that they recently released an article, realestate.com.au, and it's basically asks is your pocket of your suburb cheap, or is it the expensive part of your suburb? You can find that online on realestate.com.au, and you'll see suburbs such as Rose Bay and, for example, Double Bay, and all suburbs basically near the water with a ridiculous variance on prices. And what the reason for that is hypothetically in Rose Bay, you can get a waterfront property that could be $35 million, and then you can get a property towards North Bondi that is a little bit further away that can be $3 million. So what ultimately that does is it drags that suburb median up because of all those prestige properties and properties with, water views. It drags that suburb median up, and it creates further capital growth. So that's one of the areas I look at. But the most particular thing about being near the water is there's a restriction of supply, because you can't build on water. So the closer you are to the water,
I think the Chinese
obviously
are
less
doing
supply.
They're building islands in the middle of the South China Sea.
Yeah. Anyway, but that's one of the other things I look at. And often you if you notice, so I'll give you a hypothetical example. It's not a hypothetical, an actual example. So the income growth near the water is often significantly higher than away from the water. So a suburb in Sydney, Manly, I'm sure everyone's familiar with Manly. If you looked between 2006 and 2016, you would see that Manly, the average income rose by $858 a week. The average income in New South Wales that rose was $450 a week. So it's nearly double the average income in New South Wales. So that income demographic flows in to these suburbs, and then it obviously pushes prices up as well with it, with the restriction of supply.
Yeah. So I'm thinking about all these kind of things. So it sounds like you almost have actually. One question I want to ask: how excited are you about the census 2021 coming out of you? Are you waiting?
I could not wait.
Maybe we should wait until that came out to give us your analysis. And
that was my mental. I had that question mentally. Like, I bet he's pumped. I bet he's absolutely pumped.
I'm stoked to see it, honestly.
But so how many metrics? The question I was going to get to and ask there is: it sounds like you've got about 5 to 10 metrics. How many metrics are you actually looking at?
So I have about 5 or 6. So I should say macro metrics I look at, then another 5 or 6 micro metrics, because basically the macro metrics matter to basically identify a region or a suburb, right? But the micro metrics then obviously refine it further. So that refines, for example, streets. It refines basically where the easements run through. It refines, for example, flood zones, fire zones, anything like that. Transport systems, walk score, anything like that. Basically, you can then further improve the capital growth of a property. I don't know what Joe's done.
Sorry.
That's all right. He's still got his logo on as well.
Yeah.
Lord above. Okay. Well, one of the things that I'm interested in is that sorry about that. You have 4 properties now, 5 properties now.
Well,
Jesus,
got 5.
Yep.
Big 5. Look at that. It's even knocking down cameras. So one of the things I want to know is, let's talk about this most recent one, right? So how deep did you go? Like, what was because you sound like you're an in-depth due diligence fella. What did it look like for this most recent purchase?
So basically, I did stick to my fundamentals of I want a minimum doubling in 10 years. So that's minimum 7% capital growth. And it had to have happened in the area for roughly the last, should I say, 2 property cycles. So that's about 14 to 15 years for people who don't know how long a property cycle goes for. Each cycle is usually 7 to 8 years.
So you're relying on past data being an indication for future data.
Not only past data plus basically movement in certain suburb trends and that kind of thing. Generally, what I look for is gentrification in suburbs. And what gentrification is basically when more affluent people move into a suburb and the demographic changes in a suburb. That's fundamentally what I look at in investing, because that really changes the dynamic of what happens in the suburb and what can continue to happen towards the future. So basically what I have been doing is I first of all look at the income demographic of where it is. then I basically, following that, I do not look at any suburb that has masses of land around it, because all that does is basically allows the council to rezone it, and then basically a developer can buy it, and there's a heap of more stock. So that doesn't help capital growth whatsoever.
So for this current project, the property that you just purchased, do you mind telling us where it is, or like general roundabout?
So it's in Newcastle. It's up in the Newcastle Council region.
Yeah.
I bought it for $690. I settled it on mid-March, and I got it revalued. I got it revalued literally about a week ago for $810. So it's done quite well.
Gee, that's you've done about 18% or thereabouts.
Yeah, in a couple of months, 6-7 months. Anyway, and so the good thing about this property is it's a dual income property. So I've got council approval and everything to have 2 occupants in there, and it returns about $800 a week. So it's actually cash flow positive and on capital growth at the same point in time, which actually allows me. I'm looking again to buy another property probably in the next 3 to 6 months again.
Wow. That is a crazy outcome.
Yeah.
Well done. So what were some of the drivers? So we're looking around Sydney and Melbourne, and then you narrowed it down. You're looking for the water. So you have like a kilometer radius, like 20, 10, 15?
Well, so the water's one thing. It can also be near a CBD or an area that's gentrifying. That's another thing. An area that's gentrifying, it can be there. So basically a reason I also bought into the Newcastle Council is I eventually do plan to develop a few of my properties. And basically this one it's a corner block again. I love my corner blocks, as you guys probably know. And I can put 3 dwellings on it. So in the future, so it's already got that cash flow. You've got the ability to develop it as well. And you've got, obviously, as you can see, I've already got a fair amount of growth out of it too. So basically what I looked at for this property, however, was obviously an ability to service future loans in terms of cash flow, but also basically this suburb I bought in itself, there's a lot of infrastructure going around it, and it's had a lot of capital growth. Plus it's around a few of those good school zones and only about 8 minutes drive to the beach. So it has a lot of factors going for it, and the income growth has been around 6%. So that's nearly double the average New South Wales income growth in the last 10 years.
Yeah, and this suburb has had a 7-8% growth over the past 2 cycles. It's
had 8.4% growth. That's capital growth year on year for about the last 29 years.
So can I throw a devil's advocate in there and just say, because I mean, what happens in a scenario where you've got we've got COVID. So what happens in a scenario where you're buying at the end of that cycle and you sort of then it sort of sits flat for a couple of years? How do you navigate that kind of situation? Because yes, you've done well this one, but have you ever had that happen with any of your purchases where it's just not grown for a couple of years?
Well, obviously following the 27 changes to the APRA laws, a few of my properties obviously did drop about 10% in value, as most major markets in Australia did in value. But I think during that phase, what my strategy to do was mainly just consolidate my debt and basically wait for the market to kind of. I wouldn't say, look, I can't pick obviously the bottom of the market, but you can see some fundamental factors that happen. Like the market's very reactive. Like you can see what happens overnight. Like basically if you look at last year, for example, from literally the government saying and the news all saying property is going to drop by 32%, 40% here and there, to them then saying, oh, everything's okay. The market moved like 10% within about 3 months. It's so reactive. Yeah. So generally what I do when the market's basically falling immediately is I try to consolidate my debt. And then the minute they basically, the media and basically all of those sorts of people and
the bank and whoever,
basically whoever, they stop saying it. That's when I buy, because what that means generally is that the market's not that bad, and they overreact as they do every single time, and then I go and buy again. That's what you kind of do. And if you're clever as well, what you want to do is in that kind of time is pull that equity out and put value on your properties. That's what you can do in that time. Because you have the ability to, if you want to subdivide or develop, you can as well.
Oh, man, that's exciting. You pretty much tick all the boxes of my kind of strategy. It's like make sure you're kind of looking in areas where there's demand, of course, and not a lot of supply, but also pick value add strategies. It's almost like I don't know. It's like we read each other's minds at one stage and got in there. But you're probably doing a little bit before I was, so good on you.
Yeah.
Yeah, that's a sensational return. So how did you actually choose this exact property? Now, you've already kind of hinted a little bit there that it had a bit of a twist there. It had the corner block, which is always a sought after asset.
Yes.
So actually I am kind of interested how you got it at it sounds like a great price at that time.
If I'm straight honest with you, because I've already got a property up there, I do know a lot of the local agents quite well. So I actually got it off market. No one else looked at it but me. I put my bid in straight away, accepted, signed the contract. Basically, that's how it happened.
Did you drive down there and get it all done, or the agents like, this is what it is, this is how it is, take it or leave it?
I did drive there and obviously look at the property, because you just looking at it on the web and that kind of thing and the streets around it doesn't give you the same. It's not the same. But the fundamental factor of why I bought this property, it's the suburbs one thing, but the reason I bought it is obviously a corner block's an additional bonus and the cash flow, but it's actually surrounded by the most expensive streets in the entire suburb. So it's in the most expensive pocket of the suburb. So if you look at the neighboring streets of where it is, this is even at the time when I bought it, there was places going for 810, 850, 900, 1.1, and all those sorts of figures. And don't get me wrong, this property, it didn't look flash when I bought it, but it only costed about $2,500 to $3,000 to actually fix up what was on the inside. It wasn't that bad, if that kind of makes sense.
That's nothing.
Were you sort of looking? Were you looking for a couple of months, or I imagine you didn't just wake up one day and an agent called you and said, "Hey, Sam, I've got this property, you want to buy it?" I imagine you were.
No, I probably looked at about 60 different properties, most of them being off or pre-market beforehand. Most of them, if I'm honest. But
wow. None of those fit your criteria.
No. Well, it gets kind of quite complicated if you go past 2 properties, it gets a lot more complicated, your borrowing scenario and everything like that, because obviously you've got different financial constraints with lending and all that sort of thing. And also you got to also consider your risk, how much risk you're willing to take on, because you got to consider worst case scenario, what happens. You probably need, in my personal opinion, is a 3 to 6 month emergency fund just in case everything goes wrong. So there was a lot of factors in that. So basically,
is that per property, or is that overall you got a free 6 month?
Overall, so per property. So basically, every expense, that's loans expenses, council, interest expense, everything added up, 6 months expenses. That's my personal strategy, and it's not only because I'm not saying I'm overly like risk averse, but it also gives you the potential that if an opportunity does arise as well, that you do actually have funds for it. So hypothetically now, right, if I'm getting a val on one of my other properties that actually is in Newcastle as well. Hypothetically, if that val comes back at what I think it will come back at, I would have probably enough to maybe even purchase $100,000 more of a property. So that obviously opens up your avenues for how much growth you can get and what potential you can get out of it a lot more.
Okay, so there's a couple of things that I'd love to unpack here. Is around how you were able to look at 60 properties, and in March it was a pretty hot market. Yeah. How did you get those people, those real estate agents, to show you through all these properties, but also you're saying no to so many of them as well. You're saying no. They're like, oh, I'm going to go to Sam. He's going to buy this property because we have this relationship built. And then you've knocked 60 of them back. Like, how do you get that kind of relationship with an agent?
You basically have to tell them exactly what you're looking for, because what an agent is trying to do is, it's not all of them, so I shouldn't bracket all agents together, but some of them, what they're trying to do is just simply sell and get their sales commission and basically turn over turn over as many of them as possible. That's what a lot of, but I wouldn't say a lot. I'd say maybe 50 to 60% of them are trying to do at any given time. So for me, for example, I would have got at least probably 20 or 30 like inquiries that I didn't even go, and I wouldn't say I looked at. I just flicked off, basically saying, do you want to buy a unit? And me, if you know me well, I'm never going to buy a unit. I'm just never going to touch it.
Controversial. I love it.
Yeah. But anyway, basically a lot of the properties that I looked at were in, so I've already narrowed down to the suburb level. I only had about 3 suburbs I actually wanted to buy in the whole of Newcastle.
Yep.
Only
So
about three.
did you just blanket email bomb all the real estate agents that you see in those 3 suburbs and say, hey, I want to buy in these 3 suburbs, looking for a property that's a corner block that's valued between 600 to 700, or like, what did it look like?
No. So basically what I do personally is I say, hello, you introduce yourself. And often the thing is, I already had a relationship with a lot of them already because I'd already been buying in that area, which generally happens, and they pass your number around and that kind of thing. But of the new agents I met, I would say, hello, this is my name. I'm pre-approved for this amount of money, ready to go with the deposit now. That basically lights their eyes up, and you say, this is exactly what I'm looking for. And basically, when you say that, they'll put you straight on a database and probably put you on pocket dial. And if anything comes up, that you're the first one they call. That's basically what happens.
And then how many, you said you had a look at 60. Now there's a question here that said, what suburb did you buy in? You bought in Newcastle. What suburb in Newcastle? Or you don't have to tell us, obviously.
Well, I'm happy to say. So Mayfield
Well,
East.
you've already purchased it.
Yeah, Mayfield East was the suburb I bought in.
Go on, pump up Mayfield, folks. Sam wants more.
Sam wants more cashola.
That's it.
And then, okay, so you had 60 thrown at you like that way, through emails, text messages, phone calls.
How did you actually manage that relationship? Because it just annoys me when I get calls of people, and I'm just like, I don't have time to speak to all these people. How did you practically do that? Or you just message them back?
Often I'll message them back, or just a lot of them are happy to send it to you via email. And basically, if I didn't like the property, I'll just email them back and say, still looking, but this isn't exactly what I'm looking for. This is what I'm looking for, and just reiterate exactly what I'm looking for to them. Because obviously, as I said, agents, what they want to do is sell a property, and sometimes there are factors, for example, as in, like, they might say, this is something that will do well. It's in a good street. For me, that's good, but I want a lot more than just a street. I want the cash flow too. I want a possibility of developing it, possibly dual income, a lot of different things. So what I'm looking for, to be honest, is a unicorn property. And I hate to say that, but basically something that can give you a lot more than the average property. Because for me personally, only about 5% of properties are investment grade, but I don't even want 5%. I want probably that 1% or 0.5% to take it to that next level. Because what happens is, if you have 1% difference in capital growth, that is hundreds and hundreds of thousands of dollars down the line. And it's possibly 2 or 3 more properties. That's just the fact of the matter. So you don't want to make a mistake, because it's going to obviously not give you the potential that something could give you in the future.
So did you look at an area? Because like these, like 1%, do you know what those property looks like when you see it? Do you just be like, okay, corner block, good frontage, slight reno potential, under market value?
If I'm personally honest, under market value, I would say, isn't the biggest driving factor for me, because, to be honest, there's a saying from Warren Buffett, and he says, I'd rather purchase a great asset at fair value than a fair asset at great value, if that makes sense. And what he's talking in that sense is that if you hold it for the long term, it's going to be worth a hell of a lot more than if you buy something crap at a good price now. So I basically, the equity uplift is definitely one thing I look for. And look, me personally, that's just the way I do it. But there's a lot of properties you can see that have excellent structure to them. If you look at builds, especially in the 60s and 70s and 80s, there's plenty of very structurally sound builds out there. And but there's also a lot that then haven't been taken care of in the inside, but there's probably room for a couple of $1,000s to be made here and there with basically a few renovations or just a bit of a facelift, right? So what you can do is when you're searching for a property is look for one that is rentable but can have a little bit more done to it. So you might find a property, for example, in a suburb that rents for, say, an average of $500 a week or something like that. Structurally sound, but it has a little bit of work to be done. Maybe that's the bathroom or the kitchen or something like that. And you can do that for $2,000, but improves your rent to $580 a week. So that $580, first of all, in the bank side is going to look as a much greater serviceability factor to get future loans. Plus, not only that, but it's also going to help, should I say, lessen your risk towards the future because your rental yield's higher. So that's one of the things I look for. But particularly what I do look for, especially is as well in a suburb, is what pockets of the suburb do better than others. So in Newcastle, for example, for people who don't know it well, and it's the same as, should I say, parts of Brisbane as well. There's certain areas that do flood in Newcastle quite a lot and have a ridiculous history of flooding. So obviously pockets that flood a lot more probably aren't going to do as well as a pocket that doesn't flood, should I say, right?
Yeah.
So, and there's historically areas you can see that have done better, and you can kind of link these sorts of things together, if that makes sense. So in Mayfield East, if you look at the suburb of Mayfield itself, more towards a train line, there's a lot more, should I say, less affluent people living there. There's an old housing commission block down there, and most of it's in a flood zone. But when you go up towards the Mayfield East side, right, you've got some homes that are easily worth more than $1 million, $1.2, $1.3 million, right? There's a street, or should I say parade, in Mayfield East that's tree-lined. It's named Kitchener Parade for anyone who's watching. So properties in that street easily go for $1 million or more. So if you're buying anywhere near that street, it's obviously going to get your suburb median is going to get lifted up simply by being near that street.
Ripple.
So how do you know? Ripple effect. So how do you know those hot suburbs? Like that your area. So your area that you purchased in, there's $1 million here, there's $1 million here. Yeah. Well, how do you know that this one's not going to like? How do you know it's going to grow to that next level? Yes, it's kind of sandwiched in between, or is it just getting more pressure and more pressure and more pressure?
Yeah, well, the ripple effect is one thing that happens, but the reason you buy in a suburb like that is generally, I should say, I could see gentrification happening, particularly in that suburb. And for those who don't know what to look for, basically, if you look at a suburb and you go in it and you see often young professional families walking around, old dwellings being ripped down, redeveloped, and that kind of thing, it's probably going through gentrification. That's probably what you see. And so if you look at where I was talking about, for example, what you could see in those certain streets is new high-end dwellings going up. So I'm saying spec builds of $800,000 or more, sometimes $1 million or more, just for a single dwelling, not even a duplex. So obviously, if someone's doing that, they've probably got a family, and it's probably a house they want to live in for a long time. So if they're going to live in it for a long time, then they're probably not going to sell it. So what's that going to do to the supply? Then if there's no sales, there's going to be probably similar demand in the suburb because it's gentrifying, but no stock available. So what happens to prices then?
And the other thing that I sort of found, and the reason why I think a lot of the Illawarra and Newcastle, a lot of sort of parts surrounding Sydney, is I found where you're looking at, if you look at an area where there's these $1 million, 1.2, whatever it is, $2 million, and there's parts of it that are selling for there's neighbouring sort of streets or surrounds that are only then selling for $700,000-800,000. People aren't necessarily going to be able to afford that 1.2 million, 1.3 million. Some will, but then they still want to live in that area. So they say, this is where I want to live. I can't afford 1.2, 1.3. My borrowing capacity is 800,000-900,000. I know that I'll pay what I need to. I'll pay 850, 900, and then all of a sudden your 700K property is selling for 800 because those people want to live in that area. Is that kind of what you look at as well? I mean, it's
definitely. Well, it's interesting you bring up the northern suburbs of Wollongong because they are particularly interesting markets. So if anyone knows the northern suburbs of Wollongong, the minute you go past the Wollongong Uni in Wollongong, you basically got the escarpment, which runs, so it's basically high hills that nothing can be built on, that runs along the coast. So physically there, you actually do not have any more land you can build on at all, like none. So just by the land itself there is a critical shortage of supply. And it's exactly what you're saying. So in the northern suburbs of Wollongong, for example, there's plenty of people, and if you speak to local agents there, that are saying people from the more affluent northern suburbs are moving further south. So if you look at, for example, Thirroul, Bulli, and those sorts of places, there's comparable median income to a lot of the wealthier suburbs in Sydney. So in Bulli, for example, the average median income per week is nearly $2,000 a week. That's literally comparable to an Upper North Shore income, which is quite an affluent area of Sydney. And what they're doing is they're saying, well, we can't afford the 1.4 million or 1.5 million median price now. Let's go to Corrimal, let's go to Fernhill or somewhere like that. And a good example of what even happened is, and this left me pretty astonished, I think it was in January, February, I showed up to an auction, and it was one of the ex-Housing Commission places in Fernhill. It's a suburb right next to Ferrymeadow. I know it's close to you, Jeff. And the property I personally valued at probably maybe 690 max, maybe 700. And it went for, I think, 810 or something. Like, it was an absolute derelict property, but it went for 810,000, left the crowd astonished. And anyway, after that, I stuck around and just wanted to find out who bought it. It was a local couple who grew up in the northern suburbs of Wollongong. And that's what happens in suburbs like that. They don't want to leave their area, but they want to be able to afford an area that's somewhere close to them. It's familiar, it's close to the beach, all the general factors. And that's basically a rippling effect of gentrification, what can happen in some certain suburbs.
So how do you measure all of these things? Because it sounds like you've got so many things rattling in your head. How do you justify, this thing is more important than this thing? How do you put a number to it and come up with a solution, like an actual outcome to be like, yes, these all make sense to me? Because right now I'm like, well, you've got to have this. Yeah,
so I think so it's not every area has the same, should I say, strong underlying factor as the other. So, for example, close to the water, right, that you'd have a different factor as into close to a good school zone or something like that, should I say. So being close to the water is a lifestyle factor, if that makes sense, whereas being close to a school zone is probably a prestigious factor, if that kind of makes sense. So you're going to target different properties for different factors, should I say. So if you're buying it, for example, so this is a different factor, in a prestigious school location, right? You're not going to buy a 1-bedroom or 2-bedroom house. You're probably going to buy a 3 or 4-bedroom house, because if it's near a school zone, it's going to have a family. You're not going to be able to rent it in an area that doesn't have anything to rent to, if that makes sense.
So how important are schools in capital growth?
Moving forwards, I think very important, particularly when international borders open. This is sort of an area I think I've touched base on with you guys before. Because
that's fine. Let's go it again. Like the world has fundamentally changed since.
Yeah. So if you follow basically the migration policy, there's fast track approvals for the uber rich at the moment that is going through within Australian migration. And what uber rich is, for people that don't know, it's basically people of $5 million US net wealth or more. And basically what they're looking at doing, a lot of them, is they want to come to Australia and say, hey, let's invest in something, and they either buy a house or a business. It's basically what they buy. And most of them who are coming here do have children. So, and a lot of people who have children often want to send their kids to the best schools who are uber rich. So places that are close to these school zones often do very well in times of high migration. So going forwards, when the borders reopen, that is something I definitely see happening. Obviously, I don't have a crystal ball, but throughout history, it has happened. Like, if you look at the Upper North Shore of Sydney, for example, it's one of the most consistent capital growth markets literally in the country, and that's because of those school zones with migration. That's one of the strongest reasons why, coupled with the high income demographic, that it goes up in value so much.
But what came first, right? Like, is it the high income or is it the school?
Probably the school.
I think it's both, but yeah.
Yeah.
School,
and what about unis? So how do you factor in universities into that school equation?
Universities, I don't mind universities, but it's not the number one place I would invest. So I do think there's areas that will do well, but the problem with universities is, and a lot of people I'm sure are familiar with vacancy rates, is what happens in and out of term, and particularly with the coronavirus, is you see vacancy rates change a lot. It's very, should I say, risky within a university suburb.
Plus as well is like who's what uni student is buying a $2 million property? I mean, there might be some, but I mean, I don't know. Unless you're a doctor. I mean, if you're a doctor,
you've also got to consider as well what tenants are you going to get in the property. I don't think not many affluent couples are going to want to live next to 20 kids partying in the 3 houses next door. Like, let's be honest.
Of course, they'll be wearing masks, and I'll be.
Yeah.
They probably won't be.
Yeah.
So I think
okay, that's very interesting. Like, you hear school and you think university, and it's completely different.
I definitely don't think university. Yeah.
No,
we're almost at the 50-minute. Let's how you going with? Have you fixed up your audio issue, Joe, or we're good? Okay, and then what I think a lot of people are going to want to see is I want to see how you're molding your portfolio for what your next purchase is going to look like, and also if somebody doesn't have a $700,000 or $800,000 borrowing capacity, I'm sure there'd be a lot of the audience. If people want to see something that's not $800K to $1 million or even $700K, pop I don't know, lower pop value in the comments box, and we'll get Sam to unpack a strategy that's more for people at the $300 to $500K budget. And then let's go to our let's pay the bills, Joe.
That'd be really good. Let's do that. Let's talk about commercial property investing. It's one of those areas that confuses many people, probably because of the risks involved, but it's also one of the few asset classes that can give you a very positive cash flow from day one. With commercial property, you get some massive net yields of 6 to 10%. Now, that's not gross, that's net, which means it's cash in your pocket. This is what makes them so amazing. Your property can actually pay itself off within 10 years, grow in value, and without having you to chip in any cash at all. Now, with big rewards comes some big risk, which is why you should de-risk your investment as much as possible. The way you do this is with expert due diligence. This is why we highly recommend hiring professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. He is one of Australia's top commercial property buyers agent. With his own multi-million-dollar property portfolio of a mix of commercial and residential, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers, finding the best properties in the best location, along with the ways to avoid the dud properties. Steve has even been the one to write the book on commercial property investing in Australia, and it's a bestseller. He's been generous enough to give us a massive discount to our audience of 50% with the code OZPROP. Click the link below, get a copy today, and start your commercial property investing journey.
There
you go. And also, just because Steve, it's his birthday, and he said, look, guys, just do it, please. It's my birthday. It is actually Steve's birthday. So everyone send him a little happy birthday message. That'll be really nice. However, he's also done a little discount. He's done a little birthday thing. So if you get rid of that thing there, Jeff, he said, if you type in birthday in that code, you get the book for free.
Only for a week.
Free for a week. It's only until the rest of the week. So do that and you get a free book. So I reckon maybe that's worthwhile. Code. Oh, okay, cool. Anyway, Sam.
Yeah.
Let's talk about it because not everyone can afford these $600,000, $800,000, $900,000 properties. What would you do if you had a budget of $300,000? Like where would you go? What would it look like for you?
So there's a few different things you can do. One thing personally I would do is I'd look for a JV partner or a joint venture partner. That's one thing you can do. So that's basically a partner who you team up with to get the borrowing capacity to buy something. That's one thing I would personally look at doing because capital growth for me, especially if you're only going to buy a couple of properties, because if your borrowing capacity isn't that high, you probably can't buy a heap of properties. That's one thing you can do, team up with a JV partner. The other thing you can do is also look at areas that are gentrifying. And so for me particularly, if you're looking at areas that are gentrifying, you need to, first of all, identify what reasons is an area going up in value, what reasons have areas in the past gone up in value, for example, right? So a reason could be net migration, interstate migration. That could be a reason. There could be a shortage of stock or anything like that, a big fundamental industry, and I'm saying consistent industry, I don't mean mining. I mean, for example, big finance companies, big healthcare companies, big tech companies moving into the area or something like that. So I would look at reasons why higher people with a higher affluence would move to the area. That's one reason. But I'd say if you can find that, I'd look into it a little bit more. But my personal approach would be, one, look for that, or two, team up with a JV partner. That's what I'd do.
But if you you would team up with a JV partner, so you both have 300 plus 300, which gives you a $600,000 property. You would buy and hold that asset with that person. Isn't that a big risk of them just, life happens and you've got to deal with their nonsense and all of that stuff?
It definitely is a potential risk, but in saying that, for me, I wouldn't sacrifice capital growth. That's the main thing I wouldn't do. But look, in saying that, if you honestly are on your own and you only have $300,000, you still can do reasonably well. You just have to be very adaptive with your strategy. That's all. Because if you only have $300,000,
we'll be a bit more generous, Sam. We'll give you a 450K. Can you kind of talk us through some potential areas about the 450K market, or I think there's some metrics.
Joe will jump up and down about this, but I think Geelong has great potential at 450K still. I do think that's an area.
It's gone far. It's gone very far.
Yeah, I know. Yeah. I think it has. It does remind me a little bit of the northern suburbs of Wollongong about 10 to 15 years ago. What's been happening there and what's going on there, if I'm straight honest with you. That's an area
because you've got more expensive parts of Geelong as well, don't you? There's sort of suburbs at 700 or 800, 900K, isn't there?
Yeah.
Beautiful. And you're not far from the Surf Coast either, which you got, like, for example, places in Lorne selling for $3 and $4 million weekly.
Yeah, Lorne's a bit crazy. So what sort of are there particular, because I think these are some areas that you might be looking at for your next purchase. So feel free to hold your cards a bit close to your chest. But are there particular sort of suburbs or regions of Geelong that are stacking up more than not for you?
I'm not going to say the particular suburb, but I'm going to say look at suburbs close to the water and that are completely landlocked, because if you look around the area, there is plenty of land to build on. So certain suburbs are going to have a very large increase of supply in coming years. That's what's going to happen. And if there's a large increase of supply, you're often going to probably get first-home buyers buying them, first of all. And second of all, your supply and demand equation goes completely out the door, completely. So landlocked suburbs or suburbs close to the water in that region, I think, do have a great potential for growth that are still at that sort of very low borrowing capacity level, should I say?
Yeah, and the thing about that first home buyer sort of segment or that area is it'll be a bit of a misnomer, because you'll start to see growth, but then it'll be capped at that sort of 6 to probably 700K. So beyond that, it probably won't necessarily grow that much, because that's where the first home owners grant kicks out. Yeah. So people will be willing to pay up to that, but then beyond that, you probably might not. So it'll be a bit of
the other problem you have is
false growth, I would say.
Also, what developers do is they stage releases. So they have first, second, and third stage releases. So they can effectively also control a lot of the supply of what goes on in a market. They're not stupid. They're quite smart. Like if you look up statistics, Stockland, for example, they hold about more than 20,000 lots at any given year. So they could just release 20,000 lots tomorrow if you think about it. So that obviously is going to impact the supply and demand equation immediately.
Yeah. That's crazy. Okay, so I'm just interested about the joint venture. I just think that's crazy that you're so into capital growth that you would joint venture with someone before you would go into before you go into buying something else.
I think it does depend on your strategy a lot. Like me personally, if your risk tolerance is a little bit higher, you can buy it yourself, right? But you'd have to mold a strategy that would allow you to buy future properties and build up a bit of a cash flow machine before buying your capital growth property. That's what you'd probably have to do if you want to go it on your own. But if you want to buy one now that grows, that's what you're probably going to have to do, that will double in 10 years, for example. Because me personally, I don't think there's There's probably a few, but I don't think there's many markets under that 500K or so that I could happily say will double over 2 property cycles like consistently. I don't think there is many, if I'm straight
because
honest.
they would have already done it by now.
Yes, exactly. If it's so cheap now, how can you expect to do so well? How can you say it's doing so well?
I think I know some areas that might, but I'd need to dig a bit deeper to validate my thing.
Yeah.
But I was interested to know, Sam, what are you sort of what are the top 3 things around molding your strategy that you've done to get to FIRE? What
So basically, there's a few things I think about. So the first thing I kind of think about is, why do you choose property in the first place? And for me, it's fundamentally because of leverage, because you can borrow so much money and get such a high return on your initial investment. That's mainly the reason you borrow and go into property, and from that as well. But the thing is, when you start to get more and more properties, you realize that you do need capital growth and you need cash flow. And the reason for that is because you can't actually pull out equity if you do not have enough cash flow for the property. That's the issue. So a lot of people who have $1.2 million or $2 million of borrowing capacity can easily go and buy a property that will double in value, right? It's quite easy to do. But the thing is, can you pull the equity out and then continue to do it? And that's the biggest hurdle I think most people have. So you can negatively gear and do well, but not too significantly, should I say? Because if you gear too significantly negatively, you're not going to be able to continue to borrow money. That's the biggest thing about it. So the 2 main ideas I've found of property investing is, one, obviously we spoke about both of them, but capital growth and cash flow. So fundamentally, I think, why do you look for both of them? So how does capital growth help you to build a property portfolio? So what capital growth does is it creates equity, which can be a continual deposited fund, right? That's what you think of equity as. And you got to fundamentally think of this. How long does it take you to save $100,000 versus how quick is it to get $100,000 in equity, right? Say you're an average $80,000 a year white-collar worker in Sydney or Melbourne, hypothetically, right? And
I'll tell you, pay rise, you're getting paid that much. You need to ask for a pay rise.
You do, 100%. But anyway, just hypothetically, let's just say that. How long would it take you to save up $100,000? For most people, I'd say probably somewhere between 3.5 to 5 years. 5 years. So, but if you have a property that goes up, say, even let's just say 7% in value, and it's worth $500,000 or hypothetically something like that, right? In 2 years, you have $100,000 in equity. If you can pull that equity outright, you're not actually getting taxed on that either. So that's actually creating even more of a cash machine for you. But I'm only here talking about capital growth, right? The reason I look at another reason you look at capital growth is because suburbs of high capital growth become very unaffordable very quickly for a lot of the population. So the boat is very quick in a capital growth suburb. So a perfect example is, and this is a suburb that's not even in a city. I'll give you one. It's actually called Sunrise Beach in Noosa, and it's one of the highest capital growth suburbs in this last property boom. So you would have been able to, in 2011 and 2012, to buy a property there, a perfectly nice property for around $500,000. It's now $1.45 million in 9 years, about 9 years. So that's what capital growth does. It has a boat, and if you miss the boat, you're probably never buying it again. Another example could be the eastern suburbs of Sydney. 15 years ago, most people probably could have bought in the eastern suburbs who were a white-collar worker. Now, basically, if you're not a multi-million-dollar business owner or someone like that, it's out of reach. But so that's why you look for capital growth to build your property empire. The second thing you got to look at is, how could you build a property empire by cash flow? So why do you go for cash flow? So fundamentally, you go for cash flow because it gives you money in the pocket and it allows you to leverage yourself into buying more property and getting more loans. That's why you need cash flow, right? And but then the issue is as well, with cash flow, are you going to have that equity built up and these continual deposits to actually be able to fund your future investments? The answer is most likely a no, but you probably can, in a property boom, and especially like now, a nationwide boom, assuming you have multiple properties and they're all going up in value. But then again, just relying on cash flow, I don't think is enough. So, and with that as well, you got to consider banks' lending criteria and that too. So that's why you'd probably look at getting some cash flow. So ideally, with both of them, then basically what I look at is how can I continually buy properties that will perform well, but also have enough money to do so. So in my opinion, and from my experience, you do need a balanced portfolio. So you need both capital growth and cash flow. And the reason you need capital growth is, as I previously said, capital growth creates deposit-making machines. That's what capital growth properties are. They're deposit-making machines.
Deposit-making machines. I love that.
That's exactly what they are. And then
in terms of your existing portfolio, what did that look like? And I don't mean to like say this one did this, but what did they fundamentally look like? Did you start out with high cash, high growth, high capital growth? That's all I'm going for. Number one, boom. Number two, high growth. And then it got to a point where the bank's like, whoa, we can't lend you any more money. You need some cash flow. So you're like, I now have to balance these with cash. Or how did that, what did it kind of look like?
If I'm straight honest with you, the first property I did buy was mostly to do with capital growth, because I did understand the impact of deposits at that point in time and continually being able to service those sorts of things. Because if you think about it, right, what person can come up with, for example, enough money to fund 3 or 4 property purchases in under 10 years? Like, basically no one can. It's unless you're ahead of a corporation or CEO or something like that.
What, right? 3 or 4 property purchases in under 10 years?
Yeah.
That's what you've done. That's what I've done. That's what Jeff done.
Yeah.
I've done a little bit more creatively.
Should I say, I mean in the sense of like a portfolio of over $4 million, for example. Like,
I've not done it.
because anyone can go and buy like 10 properties in Broken Hill. You could do that tomorrow even if you're working at McDonald's, you could easily do that. But the thing is, who can do it and continually get capital growth properties? That's what you got to think.
So what does it look like? What is a balance like? Because I keep hearing this word balanced and capital growth, and like what does balanced look like? Is it a neutrally geared?
So Joe's question is, what yield do you look at for buying a property?
So
none.
Anyway, if basically 2 of my properties in my portfolio are dual income properties, and it's simply to balance if we're talking about in terms of cash flow and that sort of thing, they're very neutrally geared. My portfolio is almost exactly neutrally geared, like almost to the like decimal point neutrally geared. And the reason for that is because obviously you've got tax benefits to do with that as well, but you've also got continual borrowing capacity and equity release at the same point in time. See, I don't want to be too cash flow positive at any point in time, should I say, because I want to continually leverage and use benefits towards the future. That's what I want to do. And not only that, but there's also a lot of potential in the properties that I've bought to, for example, develop and further improve the cash machine, if that kind of makes sense. But yeah, fundamentally, what happens is when you have capital growth, you've got deposit-making machines, and then with cash flow, you've got continual borrowing capacity. And if you're lucky, you've got potential with both of those combined. You've got potential for equity release, so you could do renos and improve the value even more. You could develop, subdivide. That could be by a construction loan or something like that. And it also itself creates a less risky portfolio in general, because with capital growth, you've got lowering LVR. So your loan value is significantly less to your property value, which when you refinance, it helps with lowering the rate. So then your repayments obviously are decreasing, but with the growth, your income is increasing. And then furthermore to that, you're also less out of pocket if you have cash flow as well.
So are you still with the big 4 banks, or have you gone to second, third tier lenders?
I have all of my loans still with a big 4 bank, but with this next purchase, I probably will. I could probably either just get within a big 4 bank, or may have to go to a second or third tier lender. It's quite tight, but but fundamentally, not only that as well, but I've learnt as well with building a portfolio as well that you should also look at trusts in building a portfolio. If I'm straight honest, because it is viewed very differently by the banks, completely differently by the banks.
Particularly, it's stump up a 20% deposit, right?
Yes, that's assuming you have the deposit. So I'm not saying personally buy your first property in trust. This isn't any financial advice in saying that. But when you have that machine going, look at trust, because they are viewed very differently by banks. You're not going into personal lending, you're going into business lending. And
so you bought the most recent one in a trust?
I personally have 2 in my own name and 3 in a trust, in different trusts, should I say?
3 separate trusts.
Yes,
and that's the other thing. If you buy them all, if you buy them all in the same trust, Sam, then they would factor in the debts from that trust, right?
Yeah, it's quite it's quite a complicated way of doing things, but with the view of the banks, it's the way you probably want to do things going into the future. And I'm not saying that's everyone, but I'm saying if you look at building a large portfolio or anything like that, I would definitely have a look at trusts, 100%. There's a quote from a famous quote, and it says, "The rich own nothing but control everything." That's from John D. Rockefeller. And basically, that's what he's talking about. He's talking about wealthy people controlling things, but not owning them. And that's basically the view you want to have in the banks and the lenders' criteria going forwards if you're to build a portfolio.
So when let's not go too deep on it, but a little deeper. So when you've got a trust, you've got to go through commercial lending rather than residential lending.
Not necessarily. You certain lenders, so not necessarily, but certain lenders will allow you, in saying that you can't leverage as high. The highest you're probably going to get is usually 80%. About an 80% LVR. Yeah. Usually
so there's no LMI involved.
There's no LMI. They don't let you. Yeah.
No, they don't let you do that. And the other thing I should say, if we're going a little bit deeper, is there are different tax implications to a trust than there is to just buying it in your personal name. So in a trust, for example, you can't negatively gear. You just cannot do that. It's just something that's just out of the equation. So if you're going to do that, I'd also say
there's no capital
as well, isn't there?
No.
Yeah.
But anyway, what I'm saying is if you're going to do that, for anyone watching, I would definitely seek someone who knows what they're doing, who has done it before, because if you get it wrong, you can pay double stamp duty. So it is quite a risky thing to do if you don't know what you're doing. So I would definitely seek advice from someone who actually knows what they're talking about.
I got a question, because I want to circle back a little bit to your dual income properties. How do you find they perform from a capital growth perspective? Because that's a bit of a, I don't know, maybe a myth that dual income maybe don't perform that well. How have they gone?
It's a myth in the sense, if you're buying in an area where, for example, it's like they say guaranteed rental return, and it's an NDIS scheme or something like that. That I think definitely is a myth. Or where it's just a new build and a block of land, and they say dual income, and it can return this, but then the vacancy rate in the suburb is yay high. It could be 7 or 8%, right? And the equation's completely up. But a dual income property in an area with ridiculously low vacancy rates and a lot of fundamentals for capital growth is a property that will continually go up in value for the reasons of capital growth. But if you've got also the low vacancy rates, which are often a factor in a lot of markets that do well as well, you're not going to have too much trouble getting a tenant either. And that's ideally what you want. But the growth itself, being a dual income property, isn't going to lower its potential for capital growth. It's not really going to do that much. It won't. In saying that, it won't give that much of an equity uplift if you say you chuck a granny flat in the back or do a little bit of conversion. Subdividing it and developing it probably will give you a much more significant equity uplift. But for building a portfolio in the first place, I think it's a great way to sort of balance that cash flow out a little bit and continue to leverage yourself.
That's a lot, man. There's a lot. You covered off a whole heap of stuff here. I can see that there's a whole heap of people watching, and I think there's going to be a lot of questions. So if anyone has a questions right now about capital growth, about what Sam's done, pop them in the comments below, sideways, or wherever the hell they are, and do that. But I'd love to get your insights and thoughts on where the market's going over the next 3, 6, well, maybe not 3, but the next 6, 12, 18 months. What do you see happening? Like maybe from obviously migration piece, but also just generally.
Yeah, I don't. Me personally, I know there's a lot of scaremongering you see in the media and that sort of thing, like people saying hypothetically, like, "Oh, the market's going to crash. It's the growth is slowed and everything like that." But you see out on the news, for example, they say the market's slowing down. But wait a minute, it just did 2% in 1 month. 2% in 1 month.
Yeah, so the growth is still there, but it's slowing down. Instead of growing 10% a month, it's growing 2%. Yeah.
Yeah, and so they're saying it's slowing down from 2% a month to 1.4% a month. So that's still like 12 to 15% capital growth a year. That's astonishing. So I see it going up, in my opinion, for at least 2 to 3 more years, in my personal opinion.
Wow.
But particularly in lifestyle areas close to affluent capital cities, doing extremely well, and areas of high income demographic, because if you look now, the supply there is unbelievably low, and there's a ridiculous demand, and that will continue. It's happened in the past. It's happened pretty much throughout time. It will happen in the future. I'll tell you that right now. There's areas, for example, where even astonishingly units will go up in value as well in areas.
Could you give us some of those areas, Sam?
Some areas. No, I don't have a unit. I would still never buy a unit, but
which area are you talking about? I want the details, man.
I'll tell you. I'll happily say the unit markets, because I'm never going to buy there. But an area in Sydney that units do particularly and have performed quite well is the Northern Beaches, and the fundamental reason for that is there's so many development restrictions in the Northern Beaches. So if you go up here, there's really only units around Manly and DY. That's about it. There's a few in Freshwater, but barely any anywhere else. So there's not really any being built, and there's such a high income demographic that live here. So what happens is they eventually all want to live here, but they can't afford a $6 million house in Manly, so they go to a unit, but there's none being built. So that actually increases the price of them.
Chris Gray's stomping ground, the eastern suburbs, sort of Coogee way, will probably go all right. Yeah. I mean, has gone all right.
Well, those are suburbs. Manly and Coogee, for example, it's suburb leader. They market leaders, suburbs basically. And if anyone had been following Domain, you could have seen recently that there was a property that traded made $1.8 million in 18 months' time in Coogee. And I'm not sure if you remember my very first post on this group, but I said Coogee is the number one market in the country. And if you look at what happened there, a family basically bought a place in Coogee for $3.1 million 18 months ago. They just sold it for $4.95 million with no renovations done whatsoever. That's what happens in a suburb leader market or a key fundamental suburb that takes off.
So that's probably 50 or 60%. Yeah.
Yeah, growth in 60% growth in 18 months.
18 months. And it's a PPOR, so it's tax-free.
Yeah, that's right. That's right.
Don't have to worry about that.
But yeah, that's so going forwards, I do see lifestyle areas continually doing very well. And I think this isn't, should I say, a fundamental factor, but it's just, I think, a way of Australian life, like the beach, the sun, the surf. Everyone's always been drawn to that, and it always has and always will be. But particularly where there's a high income demographic, because a lot of the suburbs with a high income.
So how many suburbs do you actually look at, right? Like, because I think about your requirements, right? So we're looking at high income demographic. We're looking near the water. I mean, there are a lot of places, but there's also like you've just cut out all of everyone that's not within 50 kilometers of the coast. Like, how many regions do you look at? Like how many?
So the Sydney Basin region myself. So that would be from Newcastle to Shell Harbour. I do know I nearly know that to the council and everything to the back. Like every bit of the council basically planning, I know to the back of my head. I know that area very well. I know regions around Melbourne also very well because they've performed quite well in the past, and I do think towards the future they will. So that's the main markets I personally look at, because I know they have done well and they will continue to do well. So that's mainly the markets I know best, should I say.
And how do you do the research? Like, not how do you do the research, but when you're like, okay, I'm going to look at this area, what are you actually jumping on? Are you jumping on Archistar or Suburb Trends, or are you jumping on Google Maps? ABS? Like, what are you?
Google Maps is actually Google. Funny you mentioned Google Maps. It's a very interesting thing to look at, because if you look at basically the layout of the land. You can see where can be built and where can't be built. So that itself, and if you look, a perfect example for someone new could be to look at, for example, the suburb of Thirroul in the northern suburbs of Wollongong. Just look at a map view, a bird's eye view of that suburb, right? Look whether they can build any more itself. And if they can't, which I already know they can't, and know you know they can't as well, Jeff, then that's obviously going to create a major shortage of land. And obviously, if there's a major shortage of land, then you're going to have increasing demand for a suburb, because continually, if there's demand for a suburb and there's no more to be built, then there's obviously going to be demand for it and continual demand in that area, particularly if it's near the water. Another thing, so that's one thing you can do to look at. Income demographic is another thing. So I know previously I've mentioned you can go into the ABS to do that, but if you want to look at suburbs that have performed well, a great thing to look at is the Aussie Home Loans 25-year report. I mentioned that last time, but if any beginner, go and have a look at that. Look at the top 100 suburbs. It'll also give you the 20 best performing suburbs in, I think, the top 12 or something cities of population in Australia. Have a look at that. It'll show you, I'm not saying it'll show you where we'll 100% do well in the future, but it'll leave clues into what has done well and what will do well in the future. And picking up off that, you will see consistently areas that are done well have a high income demographic. A lot of them are close to the water or an affluent city. A lot of them may be close to a school zone, for example. A lot of them also might be in an area of very limited supply and high demand. There's clues that are left all the time in stuff like that. So a good starting point would be to go and look at that Aussie Home Loans 25-year report.
How often did they only release? Is that only a once-off, or how often they release that? I literally just had a quick.
Yeah, that was only a once-off, but I'm just saying, as a free guide, it's a good place to start, because it'll give you suburbs, and if you want to deep dive into a suburb and why it's done well, maybe you know the suburb, and then you're thinking, why is it done well? And you might find a reason. Maybe there's an increase in income. Maybe there's a new industry moved into the area that's fundamentally strong, or something like that too.
Yeah, I feel like you look like the opposite of how everyone else looks at a place, right? Everybody else looks at a place and they see all the data and the details and they get overwhelmed. Whereas you look at a place as a blank canvas and then you fill in the lines. You paint the picture. You're like, okay, cool. Well, this place it's got hills over here, so I'm going to draw a circle around here. Okay, where's the school? Okay, that's where the school is. Where's the town center? Okay, how far away from water? I bet there's going to be capital growth around this street, this street, this street, this street, and this street. Oh, let's turn on the details, and there it is. I bet it's
that's the beauty of capital growth. So I know I said in the past, I don't think there's that many suburbs under $500,000 that will do, for example, 7 or 8% capital growth. But if you find a suburb that, let's say, has done 5.5% capital growth, right? That's the suburb average. So there'll be places and streets and properties in that suburb that may have done, for example, 4.5% capital growth, but there's also ones that might do 7 or 7.5% for capital growth in the same suburb. So you still do have potential to find those pockets of suburbs that will do better. It's just how good is your research and how much time do you want to spend, I suppose. How much time you spend and how deep do you want to dive into it? Because there's definitely pockets in even suburbs that are cheaper that will do better. 100% there is.
So and that sort of comes back to, well, how committed are you to your own financial goals and freedom? Like, do you want it badly enough, and if you're even if you're going to outsource it, how much are you going to learn about the research these people are doing for you, I suppose, and understanding what they're doing, which is vital as well.
A big factor I think is just think about as well, if you were buying a house to live in a suburb, would you live there? And if your answer is no, it probably will not grow very well in terms of capital growth, because what you need with capital growth fundamentally is a shortage of stock. And a shortage of stock, a major reason for a shortage of stock is owner-occupiers who are long-term residents of an area. That is a key reason with a high income demographic that creates capital growth. So first things first, if you're looking at a property, would you live in it and why would you live in it? Just think of that, I'd say.
Or even the street level as well. Would you live in that street? Like, why would you live in that street, and why wouldn't you live in that street?
100%.
I got a question.
Go, mate. Go.
Okay, I'll get a selfish question, then we might we'll get Joe, and then we'll circle back into the question. So, is it possible to see 10-year length for street at the street level, or can you only see it at the suburb level?
You can do it at the street level, but you've got to be quite nifty. I'd say so. You can do it through Domain. If you want to look through Domain, you can actually search up streets and look at what prices properties have sold for, and it would actually in some ways show you the capital growth for certain streets. For example,
and how long
what do you mean? What do you mean by that?
So if you go to Domain and search up basically suburb data, and I think it's called suburb profiles or suburb data, I can't remember myself, but you can actually find exact property records and transaction records for property. So if you do enough research in that, you can find what has happened in the past and what properties have transacted for in the past in certain streets in suburbs. You can actually do that through Domain if you want to. You can go back to about 1970. So it'll give you a good, that's 50 years. So a good, 7 or 8 property cycles. So that's
how do you go back 30 years? How do you go farther?
Can we actually do it? I know Sam's on his phone, but can you want to share your screen, Joe, or do you want, or is that just
no? You do it. You do it. You do it, Jeff. Let's if Sam thinks he can point you to it, I don't know. If you're a good mouse man, let's just jump on and see if we can show you, because I feel like this is every day for you, Sam, but this is not every day for everybody else.
No.
Okay.
So
you can see my screen.
We're on your PDF right now.
Go to Domain.
.com.au.
I'll just do this. I'm going to do it.
Oh, okay. There you go. Perfect. There's suburb profiles. So
where do we go from here?
Go to research. Suburb profiles.
Yep.
So search up a random suburb, any suburb for example.
Let's go Geelong.
Okay. But Geelong's a big area though. Oh, yeah, okay. We'll do Geelong. Is it going to give us much of the...
Now,
how do we do
go to the top right corner.
Jesus.
Go back up to the top of the page. So see in that search bar, click it.
Yeah.
Click street.
Go
search up any street name, just some street name, or you can search up a suburb and click a street.
Hope Street.
Hope Street, was it?
Yep.
Road, maybe.
Can
we just do your? We do your
I
street.
think you have to type Geelong. I think you have to type Geelong, Hope Street, Geelong, because it's pulling up other states.
Street, Geelong. Here we go.
There, Geelong West. That's the one.
Click it.
Wow, this is actually really cool. Jeez, I didn't know.
It's a very small street.
Oh, is it? Go to the Geelong West one. Go to the
street that's parallel to it, the one that's longer. It'll have more suburbs.
Oh yeah, there it is. What is it? Kings.
Yep. Elgor.
There you go. Thanks for your patience, folks. Thanks for your patience.
Yeah. I think there's value in this though.
So if you scroll down on that now, you'll see structure, and it'll tell you basically all the houses. It'll tell you own occupancy rates, rented rates. And if you go down further, it'll show you sales. So that's rental properties, but properties in the street. Now, if you click on those properties, any of those properties that have been sold in the past, you can see if they've been transacted in the past, and it'll go right back to around 1970. So if you go, hopefully this is a good example. If you go...
Yeah, view more.
Wow, there you go, 1988.
1988. But we have lost him.
53K.
I think his phone went flat. So what? Oh, actually, let's get my Deal Crunch calculator. Now, for those of you that are not subscribers of our newsletter, you can subscribe to our newsletter and get the Deal Crunch calculator, which has a capital growth thing in there. Give us the dates. What is it? 1.28 million.
Yeah, we can't see it do it though, but we can do it.
No.
So 1.28 million on the in July. So let's just say 1st of July 2021. So it only sold recently.
Oh well, Well, let's just make that's the end value. So 1.2812. And then what was the last sold price before then?
So 2012. So September 2012. and it sold for 529K. Yeah, I can tell you, it's already doubled. So doubled in 9 years.
9.5% growth over the past, however long that period.
And how about we even go back to 1988, Joe? Why don't we just do it? Can we go back to 1988?
Yeah, we can. Is Sam knocking on the door?
He probably is. No. I'm just trying to see. Let's see if he's in the chat. He might not. So what do you say? Did it cut out because of being longer than an hour and a half? No. No, we're still on, man. So we're still on, buddy. Did your phone die? Okay, yep. So let's crunch it based on back to 1988. What are the numbers?
January 1988, and it's what
you're back, Sam.
You're back, Sam. Right. Welcome, mate.
My phone didn't die. I thought we just dropped out.
Yeah, it probably has. It's too much value. So we found this property here. It's recently sold. Let's just say July 20. Let's just say that recently sold at this amount now. But over the past, since 1988, it's had a 6.5% growth rate.
Okay.
I would love to see what the suburb had though, because this is probably an example of a beautiful, expensive suburb. As opposed to the median price, which is probably not 1.28 million. It's probably a lot less.
I think the problem with Geelong is it's going to have all sorts of. I mean, I suppose you got to look at the house. Let's look at we'll go down further. Okay, so if we purely look at, I mean, that's a trend, but what is the? That's
825.
Yeah, I know, but that's not. I mean. That doesn't tell me what the growth has been. That just tells me how many have sold. It's not.
You can only get the long-term growth through CoreLogic. It won't give you it on domain or real estate.
Okay, well, we'll go to realestate.com. Anyway, let's end this. I mean, do you want to look at it, Joe? I can get it up if you want.
No, we don't care, mate. We don't care. But that's an awesome tool that I didn't actually know about, and I don't think a lot of people. Whoa, there's a lot of Joe there.
Let's get back to it. So I reckon let's crack into some questions, because I think there's a whole heap that people want to ask. Unless while we're getting a couple of questions up, Joe, is there anything you want us to particularly ask, Joe?
I'm interested in crystal balling, because that's what I'm excited about. But around the migration side of things. So one thing is, what happens when these borders open up? Like, is it going to be a massive flood of capital growth for us, or what are your views on when we open our borders up?
It'll definitely create a further upturn in the market, but it will not be all areas of the market. It won't be, for example, a nationwide boom like we're seeing now. Like, if you look now, for example, at any buyer's agency, they're saying, I've made 10% growth here, there, or everywhere, right? But so is everyone else in the country, because the whole country's pretty much gone through 10% growth. It doesn't say anything if you can create 10% growth in a nationwide boom. It's whether you can sustain that growth for 2-3 property cycles. That's what really buying property is about. So I do think, obviously, if you look at migration and where the rich migrants move, it is usually to a capital city, and it's usually within certain areas of the city. So it's school zones is one area I speak about, and another area is obviously lifestyle areas. So perfect example in Sydney is Bondi Beach. I'm not saying that's somewhere I buy right now. I think in the future I'll definitely buy in the eastern suburbs, but in saying that anyway, that's somewhere where they will buy. There's a lot of high income jobs there, a lot of high growth businesses where a lot of uber rich people generally live. They generally stay together in certain areas, and that's the areas that will continue to go up and continue to lift the market up, in my opinion.
So one of the things that's kind of on my mind about like the migration side of things is we cut it off. We cut the borders off, so no people are coming in. But why is there a massive boom? And I think I know the answer to this already, but I'd love to get your thoughts on it. Like, we've stopped people flowing in. Why is there property booming right now?
Well, there is an increased supply of credit, which is one of the major reasons itself right now.
Trillions of dollars.
Most people
its interest rate is like 2%, right? So cheapest ever in history, or in history, I suppose.
It's probably one of the only times in history where you can kind of still buy a property that may be almost neutrally geared and grow at some decent level, should I say? There's not many times you will be able to do that. Now's probably one of the only times you will be able to. But that, pardon me, in saying that window is shrinking very fast, because the markets that do have quite decent cash flow and capital growth are going very, very quickly. Sure, they're moving fast.
Yeah.
Let's crack into some questions, because I'm just mindful that we're already an hour 35. So Nick asked, what is Sam's minimum? Nick, our other admin, so I'll sort of he got priority. Is also the first question I saw. What is Sam's minimum requirement for cash flow in his properties? Is that something you look at, or you don't really think that much about?
Well, so my requirement now is minimum 4% yield, but in saying that, I think that's my requirement. Someone else's would be different. Also, it depends a lot on what you want and what your strategy is. So, for example, if you're only going to buy one property, right, I wouldn't care on that much of cash flow. I would seriously just go for capital growth. That's what I would be going for. But if you want to buy multiple properties, then obviously it does have an impact on what level of cash flow you want. And another thing you got to consider is as well, what's your serviceability like? Are you just a standard income earner who earns $80,000 a year, or do you earn $250,000 a year? Because obviously you're going to have different capacity towards the future, and you should mold your strategy around what you want to do. But my personal minimum yield I look for is about 4% now. If I can get more, I will get more, which I always do want more. But anyway, that's probably the minimum I'd look for.
Nothing wrong with wanting more, Sam. I'd say. Yeah. No. I don't know you'll be able to. Sorry, Joe.
No, well, actually, what I was going to say is, right, let's just say you're a first-time property investor now. You've read a couple of books. You're ready to buy your first property. What should be? I know the answer is going to be capital growth, but I just wanted to kind of drive the point home. Like, if you buy a cash flow positive property and that's your focus, how much of a mistake can that be at a detriment to your portfolio?
Look, I'm not going to diss people who go for cash flow, because I think you can do very well with cash flow. But me personally, it's called capitalism for a reason. It's called capitalism because you build capital. That is the reason it's called capitalism, and that's how you build wealth. You're going to get taxed on cash flow, and that's probably your biggest enemy, if I'm straight honest. But the reason you buy a property because of capital growth, for me, is because you don't know what is on the horizon. So if it's your first purchase, APRA could come out tomorrow and say there's no one's allowed to borrow any more money. They're only allowed to buy so and so many properties or something like that. You actually don't know what's in the future, and having that asset that is going to go up so significantly in value will change your life in a big way. Like, if you buy a property that does 7%, or should I say 7.2%, just to keep it even, in 40 years it'll be worth, if it continues to do that, 8 times the value you bought it for. 16 times the value you bought it for, because it will doubled. It would have then quadrupled, then it would have gone up 8 times, then 16. So if you bought it for $1 million now and it's done 7.2 or so % for 40 years, it'll be worth $16 million in that time. And I'm not sure about you, but who can save $16 million in 40 years? Like, no one, really.
Can I throw one of the key arguments that people who are against, well, not against, but they throw at capital growth people, is they say, well, okay, great, you're getting capital growth, but how do you use that capital growth? Because sure, it's worth 16 million, but I can't go to the store and pay for my groceries with a toilet, or with a letterbox. So how do you use it? Yeah, I mean, of course, there's a strategy around it, but how do you navigate that kind of conversation?
Well, that's the kind of the reason why I haven't gone and bought a owner-occupier place at the moment. That's one of the reasons I haven't, because it's about building that portfolio. It's buying an owner-occupier place. I 100% understand if you're in a situation where you need to, but if you don't, basically all it's doing is it's taking your cash out of your pocket week to week. And for me, when I have enough equity and cash flow going, I'll buy an owner-occupier place eventually if I'm, for example, going to have a kid or something like that. in 10 or 15 years time, whatever it is, right? But me right now, that's fundamentally the reason why I haven't, because it's about building that portfolio and cash machine up enough that I'm satisfied with, and I don't have to worry about, for example, can I pay my mortgage this week because the rent's covering most of it, and I have choices kind of in my life, if that makes sense.
Yeah. I love how you put it, deposit duplication machine. Or what did you call it? What did you call it?
Deposit making machine.
Deposit making machine. That's such a great way to look at it, because you put in all this effort, you put in 60, 70, 100 grand deposit, and you've saved your ass off for the past 5 years, and you then get back $100 a month extra cash flow. Or you could get back $5,000 a month in equity that you didn't even think about because you haven't realized it.
That's the thing, when you're in the game of capital growth and you can pull out equity, it changes basically the whole landscape of what you can do. When you have that deposit creating machine, you can literally continually create deposits that you would never be able to save in years and years and years and years. That's the difference in capital growth and cash flow, the main difference in it. And not only that, but it also keeps you in the game for markets that will continue to go up in value. So it's, first of all, if you have both, you can, first of all, buy a property that will give you those deposits that you need. And second of all, it'll keep you in the market of those markets that continue going up in value. So obviously then having multiple properties in those markets, it actually becomes easier over time to buy more and more, and then even develop, for example. That's another thing you can do.
And it gives you options as well. You don't, it gives you options. Like I know people hate selling, but you can, I mean, not saying you should or shouldn't sell, but you can sell, which then means you're paying tax. Let's throw to some of these questions, because we'll try and wrap it up in about 2 hours. Otherwise, we'll go for 4 hours tonight.
Yeah.
So I don't think you will. I think this will be a pretty short conversation, but I could probably give more insights on this one. But Katrina asked thoughts on investing in Adelaide for growth with lower budgets. Do you know much about Adelaide, or are you going to just throw that one through the paper?
I know a little bit about Adelaide. You won't get the same, if I'm straight honest, you won't get the same growth as you would around Sydney and Melbourne, the more affluent cities. But in terms of building a portfolio, you definitely can in Adelaide, because there's obviously certain areas that will give you 5 and 6% yield, and you can continually borrow. And if I'm personally honest, and you're looking at building a cash flow base, Adelaide does very much so make sense. But if you also want to throw in capital growth as well, you could potentially build a capital growth, not capital growth, but your cash flow machine to then buy a capital growth property in the future in Adelaide. I do think it is possible.
Yeah. I mean, there's some areas that I think have gentrified quite nicely where I did the development. So I think sort of Enfield, sort of around the Glenelg sort of area. I mean, you have to look at supply. I think there is a little bit of supply, but so one thing, I think this might be Uma. I don't know if it is, because I know he wants to reach out at some stage. He said, following up on the Illawarra, or I'd say Wollongong, Wollongong, any suburbs just south of Wollongong that I'm interested to hear your thoughts on this as well, because I've got a few thoughts. But
I'm not going to give away specific suburbs, but I would say,
come on, Sam.
Suburbs. I'm not giving away. Well, considering now,
Sounds
like he's going to buy somewhere close.
Considering I've got my own business running in real estate and finance now, I can't give away my specific suburbs, but I will say there is suburbs south of Wollongong that are definitely gentrifying. I'll say that 100%. There is definitely suburbs that are going through that state.
How far south are we talking? Are we talking sort of Fig Tree south, or are we talking Dapto south? Or
no, I'm
talking
right down to Shell Cove. That's how far south I'm talking. So basically the Sydney, but right down in the Sydney Basin region. Yeah.
I think I know where you might be talking about.
I think you know what I'm talking about too. The other thing, if you're looking down there, is look up, particularly if you're talking about councils, look up basically what development restrictions and who is more development pro, because I'll tell you right now, Wollongong and Shell Harbour Council are not the same. They do not view development in the same way, particularly. So if you're interested in that area, look up their land environment plan and development control plan, because they are quite different. I'll tell you that right now.
And what are you looking for when you look into those big, wordy, annoying, bloody things? What are the things that stand out to you to say, "Whoa, this council is not very friendly for development"? Doesn't necessarily need to be the council that we're talking about. Any council, like what stands out to you?
A very easy way is seriously just go and look at past DA approvals. Because you can actually find them all online, DA approvals, and what's happened with them, what the result has been. Because some councils, for example, they'll write a specific reason as to why they reject a development plan, and you'll often also see. And another easy way to honestly do it is just seriously just go onto like a local community page and search up development. Guarantee you with councils that are against development, there's probably a whole heap of people saying no to 28 units, say no to deforestation or something like that. That often will give you enough evidence and reason to know who's development pro and who's not. You can also see within, especially development control plans, I mentioned this in the past, a lot of councils have, for example, precinct zones, like precinct areas, like urban renewal areas and that kind of thing. And often that's to promote, for example, business in an area. That might be to promote medium density in a certain area and that kind of thing. So that's what you'd look for in a development control plan. In a land environment plan, you'd probably look for what you need for subdivision, what sits under R2, what sits under R3, what sits under R4. Then if you want to go deeper, go and look at basically what development applications have been approved, what hasn't. If you want to go deeper again, go and look at a Facebook group or just a local group and search up development. It'll tell you something.
Yeah. So I think we might have uncovered one of the suburbs. So you don't have to. But Umar, who I'm sure will reach out, he mentioned Barrack Heights, which is in. I didn't necessarily know that. That one looks interesting, I would say. I
know the suburb.
The small gives it away.
So you'd buy.
Well, I'll smile to anything. So I'm not saying that's the one I'd buy.
Well, it's in the Shell Cove, Shell Harbour kind of area. So it's sort of. I mean, I haven't done the research on it, so I don't know. But
well, do you know the hot streets? You still got to do all that fun stuff. You can have a suburb, and it doesn't mean anything. You got to find the goods.
You got to remember south of Wollongong that a lot of them are ex-housing commission suburbs, and a lot of them still have areas of quite high crime, areas as well of quite high noise pollution, areas as well where there's been, for example, past industrial areas that are still quite derelict, and they won't do quite as well as other areas in those suburbs. So I'd be a bit careful.
Fringilla's an example of that, I would say.
Yeah, Fringilla's a perfect example. It's right next to the steelworks. You see smoke going up everywhere. There's been past health complaints about that suburb throughout council and everything like that. But that's what I'd say. I'd be, if whoever wants to know, I would be very careful about buying down there. But I do think there's areas that will do gentrifying and doing well, but I'd still be very careful because it's very specific streets and areas that will do well. It's not just let's buy in a suburb because that suburb's near here or that suburb's near there. It is a very, very particular market in that area that will do well. And very specific houses and streets that are going to do well. Yeah.
One question that this is going to be a little bit off topic, but let's say you're looking in an area. Where do you kind of start? So if I'm looking to research a new area that's not your typical thing, right? Let's just say you get plonked in the suburb. What do you actually look for initially to start painting that picture? So you look at the map of let's just say, do you look at the SA3? Do you look at the council? Do you just start going straight to houses? Like, how do you actually look at it as a place? Let's just say you got plonked in the middle of someone. You're like, I want you to find me the property, the street that is going to grow the best in the next 10 years.
Right. So first of all, again, the first fundamental you need to look at is demand and supply. So look for somewhere that is fundamentally completely landlocked. There's no more land that can be built on. That's the first thing 100% I would be looking for. And as you said, zoning is basically if it's landlocked, nothing can be built anymore there. So there's a few benefits to that. One is obviously there can't be more supply around, and the second thing is as well, in the future there's probably going to be changes in zoning and that kind of thing as well. If you're close to a CBD center, what they're going to do is often they're going to change zoning to allow medium density and that kind of thing around there, unless it's in a very particular like heritage listed zone or protected zone of a council area. So that's one thing I would look for first of all. Second to that as well is within that zone. So zoning is a great thing actually to look at. You can literally go online and search up New South Wales zoning map. It's the first thing that comes up on Google. You can find it yourself, every address in the state, right? You can literally look on a zoning map and just have a look and see what zone properties are in each area, the suburb and street and that kind of thing. And so one thing I did mention...
The planning portal, isn't it?
Yeah, planning portal. That's e-spatial planning portal, I think it's technically called. But anyway, in that e-spatial portal, right, you can see, for example, industrial areas, business areas, and all that kind of thing. So I previously said buy a property where an owner-occupier would want to live. If you think about, for example, in an industrial area, does an affluent family want to live near moving cranes and moving trucks and concrete and that kind of thing? No, they don't. So that will already instantly, just looking at that,
cross that off.
a suburb straight away. There you go. Yeah. There's one thing. Then another thing you can probably look at in a suburb is a good thing is walk score. Basically, walk score is the walkability factor of a suburb. Because if people are close to amenities and things that they like and need, then they don't really have much of a reason to move, do they? That's the thing. That's a few things. And then obviously if you want to dig deeper, you can look at, for example, the street level and how well streets performed. You can look at, if you're really looking at buying a property, look at where the easements are in the property, look at if there's any restrictions on the property or if it's bushfire prone land, if it's flood prone land or anything like that. There's plenty of things you can look at. Yeah.
Beautiful. Okay, cool. Well, I think we should answer another question.
Just bringing this up to this pretty much answers that you basically asked the question there, Joe. This pretty much answers that question. That's what the question was asking. The question was, well, how do you pick up the
limit the supply increases prices?
Yeah.
Well,
yes. If it's solely for capital growth, yes.
Okay.
Yep.
I love that, man. This has been a banging session again. Last year, another sensational one. Now, you've been doing some things a little bit differently, though. Before, you were a PAYG, Mr. Employee. Now, things have changed. What's going on with, you've got a business now. Give us a bit of a run through of what that is, because it's interesting.
Yeah, so basically, I've created my own, and just launched it the other day, my own real estate, finance and investments business. So basically I've got those three wings, but mainly what I want to focus around is property, because it's I personally I've done fairly well with property, but I'd like to see and help other people do well with property as well, because I have a lot of knowledge I think that I can obviously help people with and also give them plenty of understanding in property and that kind of thing. I also do bookkeeping and other financial services, for example, but the main thing I think I want to structure myself around is property, because just in general, mistakes in property are very expensive. They're extremely expensive and cost you a lot of time, which is your most valuable asset, which you will learn easily over the course of time. So I said in the past, the difference in, for example, 2% in $1 million purchase in 10 years is literally about $400,000 to $600,000. It's massive. That can mean the difference between you buying 2 more properties in that time period or none, for example. So the fundamental reason I started it is because I want to help people and give them some of the knowledge I've gained and basically allow them to then be successful in the future. Because I have no problem with people being successful, if that makes sense. But just molding your strategy the correct way is very important, extremely important. Understanding basically lending and where to buy and why you would buy that is also critically important.
Yeah. And so
what's the name?
Compound Invest. Okay. That's the name of it.
Yeah. Okay. How do people get in touch with you? What's the best way?
They can. So if you look at, you can search up Compound Invest on Facebook. It'll come up straight away, or through my profile. You'll see that it basically says I'm the founder of it, and you can click it through there, and you can find contact details and message me easily through that. I've got plenty of things I can do for people. I even actually have a suburb selection session that I run for people. I've done about 12 of them in the last week since, not week, but 4 days since I launched the company.
To individuals?
To individuals, yeah. I run suburb selection sessions, basically run give them a rundown on why I would buy in a suburb and what basically their thoughts are, what their strategy is. I run strategy sessions in. I can also not only that, but also completely basically service your portfolio. So I can do basically an initial consultation, do sort of a portfolio review, strategy plan, then a review, and continue on from there too. So yeah, basically, if you need some help regarding buying a property or what you would do in the future, I have quite a good idea of how I can help you and probably enhance your portfolio, hopefully.
Make it bigger.
Fingers crossed.
Make it grow.
Yeah.
Make it bigger.
That's it. Make it grow.
I want to throw this on.
Cash machine.
You are Vietnamese, aren't you? Not the.
Yeah, my father's Vietnamese, escaped the war, and my mother's English.
Yeah,
it's a cool combination. I love it.
Yeah.
And your dad's a surfer. A surfer as well, isn't he?
No, my dad's actually a migration lawyer. That's how I have a lot of the insight on how migration works within the country. But no, my mum is from up sort of Ballina Byron way, so that's where I get the kind of surfer mentality from. Yeah.
Chill out on the surfboard. Awesome, man. This is
everyone's
fantastic session. Well, there's so many people still on here, so I want to let them get to bed. But I think this has been so informative, man. And your thoughts on capital growth and your attitude towards it. It's not just a hyped up, energetic, fluff. It's hyped up energy towards something you're passionate about and believe in and can back up with data. Like that's the most important. Like that's such a powerful combination that I think you're going to do sensationally well.
The proven track record as well. You bought 5 properties in 9 years, so one cycle, right? So, I mean, proof is in the pudding. So I'm looking forward to seeing
particularly in recent history. So the last 3 have been all bought within about 12 months and very closely together bought. And that's kind of the thing I think you realize over the course of time. There are key times in the market and key factors in the market that will create equity uplift, and you need to take advantage of them. If you understand how the market works and basically the power of borrowing and that kind of thing, you need to take advantage when you can take advantage at that point in time.
How long is that window open for in general?
I think it's still open. I think the capital growth window is still open. It depends on your borrowing capacity, obviously, again, but I think it is still well open for at least the next 2 years, in my opinion. Still well open. But you got to remember, at the end of the day, you don't buy property for a short-term gain. You buy it for the long-term game. You don't buy it short-term. So, in my opinion, even at any point in the cycle, obviously there's better ones than others, but if you can buy a property that's going to perform well, you buy it. That is my opinion, because you're not holding it for 1 year. You're holding it for at least a cycle. Unless you're obviously developing or flipping, which I personally haven't done yet, but I probably will develop in the future, but I'll probably develop and hold. I wouldn't sell.
You're buying properties that has the potential, but you don't need to do it right now, so you just don't need to. Yeah.
No, I have no intention yet. In the future, yes, but
absolutely. Awesome, man.
Yeah.
Cool. Is there any other final thoughts that you wanted to add in there, man?
No. Or if you want, obviously, if you want any advice or anything regarding real estate, feel free to message me through the business or anything like that. I'm pretty open and honest person. I'm pretty down to earth as well, so I'd be more than happy to talk about real estate to pretty much anyone.
Mate, you've been doing it for the last 2 hours and you've done well. Awesome. Okay, guys.
All right.
Let's wrap it up.
Have a good one, everyone.
Have a good one, guys. Let's go buy a property.
Yeah.